$2 billion. That is how much cash was supposed to be sitting in bank accounts in the Philippines. Auditors had signed off on it. Investors believed it. The German government defended the company. And for years, anyone who questioned the numbers was threatened, sued, or ignored. Then in June 2020, the truth finally came out. The money did not exist. It had never existed. This is the story of Wirecard. Wirecard was founded in 1999 in a suburb of Munich, Germany. It started as a small payment processing company, handling online transactions for businesses. In its early years, it was unremarkable. But in 2002, a man named Markus Braun became CEO, and everything changed. Braun was an Austrian-born technology executive with a PhD in computer science. He was quiet, methodical, and intensely private. He always wore the same outfit, a black turtleneck, which earned him comparisons to Steve Jobs. But unlike Jobs, Braun did not build revolutionary products. He built a story. And that story was irresistible to investors. Under Braun's leadership, Wirecard positioned itself as the future of financial technology. It processed payments for online merchants, issued prepaid debit cards, and provided banking services through a subsidiary. The company claimed it was growing at extraordinary rates, expanding into Asia, the Middle East, and beyond. By 2018, Wirecard had achieved something remarkable. It replaced Commerzbank, one of Germany's oldest financial institutions, in the prestigious DAX 30 index. This meant Wirecard was now considered one of the 30 most important companies in Germany. Its market value reached $28 billion. Braun was celebrated as a visionary. But there was a problem. A significant portion of Wirecard's revenue was fake. The fraud centered on something called third-party acquiring, or TPA. Wirecard claimed that in countries where it did not have its own licenses to process payments, it used third-party partners. These partners supposedly processed billions in transactions and sent the profits to Wirecard. The money from these partners was allegedly held in escrow accounts at banks in the Philippines and Singapore. On paper, the TPA business was enormously profitable. It generated hundreds of millions in revenue with almost no costs. That should have been a red flag. In the payments industry, margins are thin. A business segment that generates pure profit with almost zero overhead does not exist in reality. But analysts and investors did not question it. The growth story was too good. The first serious warning came in 2015, when a team of investigative journalists at the Financial Times began looking into Wirecard's operations. A reporter named Dan McCrum started publishing articles questioning the company's accounting. He found evidence that Wirecard's offices in some Asian countries were either tiny operations or did not seem to exist at all. Wirecard's response was ferocious. The company hired lawyers and private investigators. They accused the Financial Times of conspiring with short sellers to manipulate the stock price. They filed criminal complaints against McCrum and his colleagues. In an extraordinary turn, German financial regulators sided with Wirecard. BaFin, Germany's financial watchdog, actually filed a criminal complaint against the Financial Times journalists for suspected market manipulation. They banned short selling of Wirecard stock. Think about that for a moment. The regulator tasked with protecting investors was actively protecting the fraud and attacking the people trying to expose it. Inside Wirecard, the man running the day-to-day operations was Jan Marsalek, the chief operating officer. Marsalek was the opposite of the quiet, reserved Braun. He was charismatic, well-connected, and mysterious. He claimed to have contacts in intelligence agencies around the world. He traveled constantly, meeting with politicians, spies, and businessmen in countries from Russia to Libya. Marsalek was also the architect of the fraud. He controlled the TPA business and the relationships with the supposed third-party partners. These partners were shell companies, many of them controlled by associates of Marsalek himself. The transactions they supposedly processed were largely fictional. But the fraud needed one critical element to survive. The money had to appear to exist somewhere. This is where the Philippine bank accounts came in. Wirecard claimed that approximately 1.9 billion euros was held in trustee accounts at two Philippine banks. Every year, the company's auditor, Ernst & Young, needed to verify these balances. And every year, they received confirmation letters from the bank stating the money was there. Except the letters were forged. In 2019, the pressure on Wirecard intensified. The Financial Times published a new series of articles with detailed evidence of accounting fraud in Wirecard's Singapore operations. This time, the evidence was harder to dismiss. Wirecard's board was forced to act. They commissioned KPMG, a rival accounting firm, to conduct a special audit. KPMG spent months investigating. Their report, published in April 2020, was devastating. KPMG could not verify the existence of the TPA revenues. They could not confirm the Philippine bank balances. They noted that Wirecard had been unable to provide basic documentation for billions of dollars in transactions. Still, Wirecard survived. Braun held a press conference and claimed KPMG had simply not been given enough time. The stock dropped but recovered. Investors wanted to believe. The end came in June 2020. Ernst & Young, after years of signing off on the accounts, finally decided to actually verify the Philippine bank balances directly. They contacted the two banks. Both banks responded with the same message. The accounts did not exist. No money from Wirecard had ever been deposited there. The confirmation letters that Ernst & Young had relied on for years were forgeries. On June 18, 2020, Wirecard admitted that 1.9 billion euros in cash probably did not exist. The stock price collapsed. Within days, Braun was arrested. The company filed for insolvency. It was the largest corporate fraud in German history. But Jan Marsalek was gone. On June 19, one day after the announcement, Marsalek told colleagues he was flying to the Philippines to investigate. He never arrived. Instead, evidence suggests he flew from Austria to Belarus on a private jet, possibly using a diplomatic passport. From there, he disappeared. For years, intelligence agencies searched for Marsalek. Reports placed him in Russia, where he allegedly received protection from Russian intelligence services. In 2022, German prosecutors confirmed they believed Marsalek was indeed in Russia and had been cooperating with Russian intelligence even before the fraud collapsed. Some investigators believe Marsalek had been a Russian asset for years, and that the fraud proceeds may have been used to fund intelligence operations. The aftermath was catastrophic. Investors lost billions. Pension funds, retail investors, and institutions that had bought Wirecard stock or bonds saw their money evaporate. Ernst & Young faced massive lawsuits for failing to detect the fraud despite being the auditor for over a decade. BaFin, the German regulator, was humiliated. Its president resigned. The German government passed new laws to prevent a repeat, but the damage to Germany's reputation as a financial center was done. Markus Braun went on trial in December 2022. He maintained his innocence, claiming he was deceived by Marsalek and others. The trial became the longest and most complex fraud case in German legal history. Braun faces charges of fraud, market manipulation, and breach of trust. One of the most damning aspects of the case is how many people enabled the fraud through willful blindness. Ernst & Young never physically verified the bank accounts until it was too late. German regulators attacked whistleblowers instead of investigating the company. Investors ignored obvious red flags because the growth story was too attractive. And the German media largely treated Wirecard as a national champion, reluctant to question a rare German technology success story. The Wirecard scandal revealed something disturbing about modern financial markets. A company can fabricate billions in revenue, forge bank statements, and deceive auditors, regulators, and investors for years. The systems designed to prevent exactly this kind of fraud, audits, regulatory oversight, and financial journalism, all failed. And when they did work, when journalists published the truth, they were punished for it. Dan McCrum, the Financial Times journalist who first exposed Wirecard, later wrote a book about his experience. He described receiving death threats, being followed by private investigators hired by Wirecard, and watching helplessly as regulators sided with the fraudsters. He won multiple journalism awards, but the experience left him shaken. As for the 1.9 billion euros, investigators believe it never existed in the first place. The TPA business was a fiction from the beginning. The revenue was invented, the partners were fake, and the bank balances were forged documents. The entire foundation of Wirecard's success was a lie. Today, Marsalek remains at large, believed to be living in Moscow under Russian protection. He is one of Europe's most wanted fugitives. The question that haunts investigators is not just how the fraud happened, but how many people knew the truth and chose to look away. Because in the end, the Wirecard scandal was not just about one company's lies. It was about an entire system that preferred a comfortable fiction to an uncomfortable truth.